Welcome back, dear students and scholars. In video 1, we build the capitalized cost of property, plant, and equipment. Now we move from cost to expense. This lesson explains how that approved asset cost is allocated through depreciation or depletion, and how later spending is judged as either a capital improvement or a period expense. Think of this as the second life of PP&E accounting. First, the asset enters the register. Then, period by period, accounting asks how much of that cost has been consumed and whether any later cost has created a new future benefit. Depreciation matters because it is an estimate with long financial statement consequences. A wrong useful life or method can distort profit, asset balances, margins, tax differences, and impairment analysis for several reporting periods. Depreciation is not just arithmetic, it is judgment supported by evidence. If the estimate is weak, the financial statements may still look neat, but neat does not always mean right. Accountants know this well. A spreadsheet can be perfectly formatted and still be perfectly wrong. Here is a roadmap for video 2. We begin with the depreciable base, which is cost minus residual value. Then we estimate useful life, select a depreciation method, handle partial year timing, analyze subsequent costs, introduce depletion for natural resources, and finish with fixed asset close controls. The goal is not only to compute the amount, the goal is to support the amount with evidence that can survive audit review, management review, and the year end close process. Under ASC 360, depreciation allocates PPE cost less residual value over the periods expected to benefit from the asset. The method must be systematic and rational. That means depreciation is not a valuation exercise and it does not try to track market value every year. It is a cost allocation process. The asset's expected useful life anchors the period and the benefit pattern drives the method. The simple formula is depreciable cost equals asset cost minus residual value. The depreciable base is the amount that will be allocated to expense over the asset's useful life. Start with the full capitalized cost. Then subtract estimated residual value, which is the expected value at disposal or retirement. If residual value is ignored or set unrealistically low, depreciation expense may be overstated year after year. Good estimates should be supported by disposal history, market data, appraisal evidence, or similar support. Residual value is not a random plug to make depreciation look nice. Useful life is not simply how long an asset can physically survive. The accounting estimate reflects expected economic use to the entity. Technology may make equipment obsolete before it breaks. Wear and tear depends on maintenance and operating conditions. Usage level matters when production is heavy. Legal or lease limits may cap the period of use. Business plans, such as a facility closure or replacement cycle, may shorten the expected life. So, useful life is an accounting estimate, but it should never be an accounting guess. The depreciation method should match how the asset's service potential is consumed. Time based methods work when age, passage of time, or obsolescence drive economic decline. Straight line gives equal annual expense. Declining balance and sum of the year's digits front load expense. Activity based methods work when output, miles, hours, or extraction units drive consumption. Group and composite methods can be used for pools of assets when the policy is properly supported. The method must be rational and systematic, not selected because it creates the most convenient profit number. The straight line method is simple and widely used because it gives equal depreciation expense each period. In the 2026 example, the equipment cost is $240,000, residual value is $24,000, and useful life is 6 years. The depreciable base is $216,000 and annual depreciation is $36,000. Each year, the entry is debit depreciation expense for $36,000 and credit accumulated depreciation for $36,000. After year 1, book value is $204,000, and by the end of year 6, book value reaches the residual value of $24,000. Accelerated methods recognize more depreciation in earlier years and less in later years. This makes sense when the asset delivers more service potential early in its life. Declining balance applies a fixed rate to beginning book value. Double declining balance uses twice the straight line rate. For a 6-year asset, that rate is 2 times 1/6 or about 33.3%. Sum of the year's digits uses a decreasing fraction applied to the depreciable base. The memory hook is easy: early benefit, early expense. Just do not use acceleration merely because management wants a smoother earning story in reverse. Partial year depreciation deals with assets placed in service or disposed of during the year. A full annual charge is usually not appropriate if the asset was used for only part of the year. The most precise approach is proration by months in service. For example, an asset placed in service on April 1st would receive 9/12 of annual depreciation in year 1. Practical conventions such as half year or full year or none rules may be acceptable if they do not materially distort the statements. Whatever convention is selected should be consistently applied and documented. Units of production depreciation links expense directly to actual output or usage. It is best when physical usage, not time, drives asset consumption. First, compute the rate, cost minus residual value divided by estimated total units. Then multiply that rate by current period units produced. In the example, cost is $500,000, residual value is $20,000, and estimated total production is 240,000 units. The rate is $2 per unit. If year 1 output is 38,000 units, depreciation expense is $76,000. Group and composite methods simplify depreciation for pools of assets. The group method combines similar assets such as a fleet of delivery trucks. The composite method combines dissimilar assets such as a building, HVAC system, and elevator. A weighted average rate is applied to the pool. The key caution is disposal accounting. When one asset is removed from the pool, gains and losses are generally not recognized separately. Instead, the difference is absorbed through accumulated depreciation. This is a classic exam trap because it differs from individual asset disposal accounting. Book depreciation and tax depreciation follow different objectives. US GAAP depreciation reflects expected useful life, residual value, and benefit consumption. Tax depreciation, such as MACRS or bonus depreciation, follows tax law and may ignore residual value. Using tax depreciation automatically for US GAAP usually violates the systematic and rational allocation requirement. The difference between book basis and tax basis creates temporary differences under ASC 740. In early years, tax depreciation may exceed book depreciation, often creating a deferred tax liability that reverses later. After an asset is placed in service, spending continues. The label on the invoice does not decide the accounting. Repair, overhaul, replacement, betterment, and renovation are only words. The real question is whether the expenditure creates measurable future service potential beyond what the asset already provided. Routine repairs usually restore current condition and are expensed. Betterments that increase capacity, efficiency, quality, or useful life are capitalized. Renovations and overhauls often require careful splitting because one project can contain both capital and expense elements. The capitalize or expense decision should be made sequentially. First, ask whether the cost increases capacity, improves efficiency, adds functionality, or extends useful life. If yes, capitalization may be appropriate. If the cost only maintains existing service potential, it is generally expensed. Then ask whether a replaced component can be identified. If a component is replaced and its carrying amount is known, the old component may need to be removed. The key discipline is documentation at the time of the decision. Retrospective explanations prepared after audit questions arrive are rarely as convincing as contemporaneous evidence. Now let us apply the subsequent cost logic. In the 2026 replacement case, the machine has a book value of $300,000 and 5 years of remaining life. The company spends $90,000 on an upgrade that increases output capacity and extends the remaining life to 7 years. Because the future benefit test is met, the upgrade is capitalized. The entry is debit PPE for $90,000 and credit cash or accounts payable for $90,000. The new carrying amount is $390,000 and straight line depreciation over 7 years is approximately $55,714 per year. Prior depreciation is not restated. Relocation and rearrangement costs require the same future benefit analysis. If an asset is simply moved to a new facility and performs the same function, the move does not create new future economic benefit. Those moving costs are expensed as incurred. But if equipment is rearranged or reinstalled in a way that clearly improves workflow, throughput, or operating efficiency, capitalization may be appropriate. The important point is evidence. A vague statement like the layout feels better is not enough. Accounting needs support that the activity produces measurable future benefit. Depletion is the cost allocation method for natural resource assets such as oil and gas reserves, mineral deposits, and timber tracts. The depletion base may include acquisition cost, capitalized exploration and development costs, restoration and reclamation obligations, less residual value. The unit rate equals depletion base divided by expected recoverable units. Period expense equals the unit rate times units extracted. The journal entry is debit depletion expense and credit accumulated depletion. If reserve estimates change, the remaining depletion base is allocated prospectively over the revised remaining recoverable units. Prior periods are not restated. Useful life, residual value, and recoverable units are accounting estimates. When new evidence appears, accounting updates the estimate prospectively under ASC 250. New evidence could come from operating data, maintenance records, appraisals, market changes, or management strategy. If the useful life changes, future depreciation is recalculated using the remaining book value over the revised remaining life. Prior periods are not reopened just because the current estimate is better. That is a relief because accounting already has enough work without time travel depreciation. Depreciation controls are essential because the process is not self executing. Each close should verify additions, disposals, placed in service dates, useful lives, residual values, depreciation runs, repairs review, idle asset flags, and the reconciliation between the fixed asset subledger and general ledger. Each checklist item should have evidence and a control owner sign off. Verbal confirmation is not enough for audit purposes. Common failures include assets in service but not in the register, stale useful lives, repair charges not reviewed, wrong system parameters, and unreviewed methodology changes. Let us recap video 2. The depreciable base sets the amount to allocate. Useful life sets the timeline. The method sets the expense pattern. Partial year rules handle timing. Subsequent cost analysis decides whether later spending is capitalized or expensed. Depletion applies unit based cost recovery to natural resources. Close controls confirm that the register, depreciation run, and approval evidence are complete. In the next video, we move to impairment indicators and ask when a PPE carrying amount may no longer be recoverable. If this lesson helped you, please like the video, subscribe to the channel, support the course, and share it with colleagues who want practical US GAAP explanations.